Okay, I'm going to get started. So thank you for joining, everyone. My name is Lewis Talbot. I'm the CEO and founder of City Internships. What we're going to cover over approximately the next 15 minutes is a CV workshop with a particular focus on banking and financial services. What you guys will see in front of you is a window in which you can fire questions. There's actually a very small number of us on the webinar today. So I'd like to shift from a very linear presentation to a Q&A. So if we dedicate the first 5 to 10 minutes of the presentation to me walking you through the 10 or so slides that we would normally cover, and then we can dedicate perhaps the remaining 5 to 10 minutes of the webinar to answering your questions. So we'll structure our webinar like this. I'll introduce myself. I'll walk you through the general feedback or guidance that we have on building an effective resume. And then at the end, we'll spend as much time as possible fielding questions from you that you may have, either about what to include or exclude from your CV with reference to a career in banking and financial services, or really what I think would be more productive is, thanks, or really what would be more productive is you guys asking what career path you should be pursuing as graduates, what options are open to you, and then we can reverse engineer what your CV should look like in order for you to stand a chance of gaining entrance into those various fields. Okay, so I'll start with section 1 of 3, the introduction to me. So my name's Lewis Talbot, and as I mentioned earlier, I'm the CEO and founder of City Internships. Prior to forming City Internships, I graduated in 2006 with an economics degree from Loughborough University. I had a very good idea of what I wanted to do with my career, which was to be a fund manager. Where the idea came from, that's what I wanted to do. I think it was a combination of the world of financial markets seemed reasonably exciting. I wanted to earn a good living, and banking and financial services seemed to be a place where I could earn a good living, be intellectually challenged, and have a job that would be exciting enough to get me up every morning. So I spent a good deal of my time at university learning about financial markets, realizing that my economics degree actually prepared me pretty poorly for a career in banking financial services. So I spent some time following the stock market, reading the financial press, and generally teaching myself about how the industry worked. So on graduation, I'd applied to a handful of organizations. Among the two that were most promising, the two organizations that I got furthest with in the interview stages, one was Merrill Lynch and the other was Goldman Sachs Asset Management. I ended up taking an offer to join the Merrill Lynch graduate program starting in summer 2007, where I joined the European equity team. I spent roughly 2 years with the European equity team, learning how to be an equity analyst with a view to becoming a fund manager. In around about 2009, BlackRock had acquired Merrill Lynch Investment Management and launched a brand new business area that was called BlackRock Solutions. And within BlackRock Solutions, there was a brand new division called the Financial Markets Advisory Division. That division was responsible for advising other investment management firms like BlackRock and like Merrill Lynch Investment Management as to how best invest, how best to analyze the risk exposure and attribute performance, and generally manage money in a much more scientific way. Now, that was 2009, and things were about to get very exciting within financial markets, to say the least. And by exciting, I mean almost cataclysmic. So that was a time when a number of large investment banks were going bust. The knock-on effect were many investment management firms and insurance companies and central banks were in a state of extreme dysfunction. So I had, through my role in the financial markets advisory group at BlackRock, essentially a front seat to what felt like the end of the capitalist world. It was a very exciting time. It was an extremely busy time, and we advised the Fed, the European Central Bank, along with a number of large investment management firms, pension funds, and corporations, on how to best navigate and survive the financial crisis. And as many of you should know, many of those firms didn't survive, and therefore there was a lot of work involved in cleaning up the mess that resulted in those firms failing. In 2011, I made what seems like a very unusual decision to leave financial services and form City Internships. So the conversation that we're having now is really the culmination of two interests of mine: banking, financial services, and getting into a meaningful, rewarding career path as a graduate. So two things that have been in some degree of turmoil over the past couple of years. So we'll move on to discuss section 2 of the presentation now, which is really talking about the state of the graduate market. It's very important that you view it as a marketplace. There is supply and there is demand, and the interaction of those two things and knowledge of the interaction of those two things will help you position yourself as a credible graduate that will be a good asset to a good firm come graduation. While I'm walking you through the state of the graduate market, I'm going to be throwing a couple of statistics at you. Don't worry about taking all of those statistics on board. I'll try and summarize the key message that those statistics relay at the end of each slide. The other thing I'd like you to do while I'm walking you through the state of the graduate market is to do a couple of things for me. In the box that I described earlier, the live chat box, if you could begin firing questions at me that we could answer towards the end of the presentation of the webinar, then that should give us a fairly seamless segue from me talking at you to answering questions for you. If you need inspiration on what questions to ask, I'd suggest that they come in two forms. On the one hand, if you have an idea what you want to do come graduation, tell me. If, for instance, you want to go into investment banking on the sales side, tell me, and then I'll be able to frame my answers appropriately. If you want to go into investment management, i.e. on the buy side, then equally, tell me. If you don't know what the difference is between the sell side and the buy side, tell me, and I'll take some time to explain what that is at the end. The second kind of question you can ask is what should you include on your resume, and I'll touch on those things in the next few minutes anyway. But questions along those themes, or perhaps any other kind of question, I'd be happy to field. Okay, so we're going to start the market overview at the moment. So there's a little bit of information about me and a summary of what we're going to do. We're going to talk about the market, we're going to talk about building and marketing your CV, and then the summary and final thoughts, given that the small number of us in attendance, will instead dedicate to to answering your questions. Okay, I'm just going to wait, given that there's a delay when I change slides to when you see them. So what you'll see in front of you in just a moment is 4 statistics that describe the current state of the graduate market. So generally speaking, the graduate market is in a better shape than it was certainly 5 years ago, and arguably even 10 years ago. So most statistical evidence suggests that the graduate market has recovered relative to its pre-recession levels in terms of the number of vacancies available. So that's very good news. That essentially means that there's been a fairly steady trend over the last few years in employers increasing the number of graduates that they are seeking to take on. That of course is a very good thing. So the demand for you guys is increasing. Let's spend a little bit of time talking about the supply of you guys. So as the first 2 bullet points here show, there are 2.5 million graduates that enter the jobs market in the US every year. The equivalent number in the UK is 370,000. So you will be competing with that number of people come this summer. The downside of the gradual and recent increase in graduate vacancies is that there was a low number of graduate vacancies for the past 5-6 years. What that means is you won't just be competing with the 2.5 million and 370,000 people that will be graduating this year. You'll be competing with people that graduated last year, the year before, and perhaps even the year before that. So while the demand for graduates has increased, the supply of graduates has also increased. And a statistic that we don't refer to in this particular presentation, but one that I think is probably the most important one to remember, generally suggests that a college education, or a degree at least, has declined in importance in terms of its effectiveness or impact in securing a job for you. So a statistic that is fairly interesting and was collected by McKinsey & Co. a couple of years ago, surveyed university academics and educators and asked them how many of them felt that graduates were well prepared for work by the time they'd completed their studies. The proportion of educators that responded positively, i.e. they believed that graduates are well prepared for the working world, was 70%. The equivalent percentage of employers that were included in the same survey was 50%. So there's this disconnection between university and the working world, where educators en masse feel that you are being sent off well armed to succeed in the working world. Fewer than half of employers agree with that. Given that you need to be selling yourself to employers, I think it's very important that you bear that statistic in mind. So what we're going to talk about in the remainder of this presentation is what can you do to help demonstrate to an employer that you're well prepared, that you're a good investment, that you'll be an asset to the firm. And clearly a degree alone is not persuasive enough of that fact. Okay, so just alluding to these statistics here, 2.5 million graduates enter the market each year in the US, that's 370,000 in the UK. In the UK, London is a magnet, so you would expect graduate jobs to be slightly more competitive in London and in larger cities. As I alluded to earlier, a good number of employers have seen an increase in the number of graduate applications which arguably offsets the increase in the number of jobs that are available. Okay, when you arrive at the next slide, you'll see that we've included some statistics relating to the UK and US that really convey that the graduate hiring appetite, i.e. demand, is increasing. So that slide will arrive in front of you now. A third of the UK's top employers have seen an increase in vacancies. The important thing to note, and this has been fairly steady for about the last 7 years, is that the majority of, sorry, not the majority, actually, it's 30% here on average, of vacancies are filled by graduates who have previously worked at the organisation. In other words, a third of graduate jobs are given to interns or graduates who've previously interned with the company. This 30% figure actually represents the broad graduate market. When you look at professions such as law, professional services, and certainly financial services, you tend to see that figure around about 50%. So it suggests that 1 in 2 graduate jobs are given to students who have already interned with the company. What we don't know is, of the other 50%, where those students come from. So do they have connections with the company? Do they have a connection from their college to the company? What we do know is that if you have any form of work experience at all, then you are 3 times more likely to arrive in the industry that you want to. So I would suggest that the main takeaway from this page is that if you have internship experience with a company, then there is a good chance that will lead to a permanent role with the company. And beyond this slide here, in knowing that you're 3 times more likely to pursue a career in your desired field if you have work experience, then the general conclusion of this slide here should be that work experience will be one of the most influential areas of your CV. So we'll spend a little bit more time talking about that later. Moving on to the next slide, which will, given the delay, arrive with you in a couple of seconds. We're talking more explicitly about work experience and the impact that it would have on you securing meaningful and rewarding employment as a graduate. So I'll come to the chart on the left in a second, but generally speaking, more than half of employers suggest that if you have no work experience, then they'll not even consider you for a graduate job. And here's some statistics as well that say the majority of US students have some form of work experience before they graduate. We're catching up. The value of work experience is being recognised as widely in the UK. So I'll just draw your attention to the chart on the left-hand side. What the chart demonstrates is a couple of things. Is that if you graduate high school and then enter the job market, you can expect to earn less than if you attend college. That's a fairly obvious statement, but the implications are slightly more complex than that. What it means is that going to college or university is still a very good idea. As a graduate, your earnings premium, and these statistics are based on US research, is $17,500 a year. Given that it costs the average student in the US roughly a third of $1 million to attend college, then there's clearly a trade-off. In the short run, you are better off entering the job market after high school. However, once you reach the age of 43, then you would expect to be in positive territory with regard to the investment you've made in your university or college education. So overall, you would expect to earn more over the course of your life. That graduate premium, let's call it, has eroded slightly in the last few years, given the increase in the cost of attending university, and that's true in the US, and it's certainly true in the UK, with the recent removal of a cap on tuition fees. So the grey line represents your earnings potential if you graduate high school and enter job market. The blue line represents your earnings potential if you graduate college and then enter the jobs market. The age 43 represents the age at which you break even on your college degree and therefore start being better off having gone to college rather than not. The orange line relates specifically to, let's call it the CI premium. So over the past 6 years, we've seen that students that graduate from our program go on to earn more upon entering the job market. It's actually 30% more. So the average graduate salary is about $37,000 in the US. It's about £21,500 in the UK. So the impact of you earning 30% more the year that you enter work means that you will break even on your college education roughly 8 years sooner. So you'll see over the course of this presentation, and if you ever refer to the City Internships website, we describe a trade-off of 8 weeks for 8 years, i.e. 8 weeks spent on a City Internships program means that you break even on your investment in your university education. That will essentially be my final and only plug for City Internships. And if you guys are interested, then I'll happily answer questions about City Internships, why we formed the company, what we hope to achieve through the company, and what the company has actually achieved. But unless you guys encourage me to talk about it towards the end of the presentation, we'll leave the subject of City Internships for now. What I'd like to then walk you through is really the third, and let's describe it as the final section of the presentation before we reach the Q&A. Now we're talking specifically about your CV. I would hope that many of you have either attended classes or read some form of material as to what your CV should entail. The following pages are a description of how a CV should look in general. So we'll go through these points very quickly, and then I'll conclude before moving on to your questions as to if you're wishing to pursue a career in banking and financial services, the things that your CV or your resume must absolutely contain. Okay, so the next slide you'll see shows two almost randomly selected resumes, just so I can give you an idea of the general structure of your resume. So there's two examples here. Generally speaking, the structure is the same. You should first start with your education. Your second section should refer to your work experience. And then your third section should really be a catch-all section that describes your language and technical skills. This is a pretty important area, your extracurricular activities and interests. Within your education and work experience section, everything should be relayed in reverse chronological order. You'll see here that these two resumes are single-page resumes. In the UK, a 2-page CV is commonplace. Generally speaking, there is an increasing preference for 1-page resumes. The reason being is that as a recruiter, I might spend anywhere between 5 and 7 seconds when I first review your CV. That 5 or 7 seconds is generally enough for me to determine whether your CV lands in the no or the maybe pile. There generally isn't a yes pile at the first stage. So in those 5 seconds, I'll be first looking at your academic experience. What university did you attend? What subject did you attend? What are your grades? And when will you be graduating? I might look at relevant subjects and courses that you've studied as well. That will take me 2 seconds to absorb that information. I'll next spend most of my time, let's call it 4 seconds, your work experience section. There I'm looking for a couple of things. The existence of any form of work experience tells me that you know what being in a professional or commercial environment is like. So there is value. Even if you spent a summer as a postman, as I did, and it was the best summer of my life, or whether you spent evenings, a part-time job at a restaurant or something like that. Those are worth including on your resume, given that they convey that you have some familiarity with the working environment. You have familiarity with having work commitments and earning money as well. Ideally, what a recruiter would be looking for in your cases is some relevant work experience with a financial services organization or similar. For broad-based financial services, the universal skill set is a degree of numeracy and specifically familiarity with financial statements and financial analysis. So if you've started your own business and for that devised a business plan, then that's valuable, relevant experience. If you've worked in a restaurant or a shop or you're a member of a student society and you've managed that society's finances, then that's relevant experience. If you've worked in an accounting firm or an investment management firm or even an investment bank, and you've spent some time analysing financial statements and understanding financial terms and language, then that's highly relevant experience. Within your work experience section, generally speaking, it should be structured in reverse chronological order, so your most recent experiences first. I would suggest that if you have experience that is more relevant than others, then there's no harm in you organising that section in that way. The skills, activities and interests or extracurricular section will receive perhaps a second or two's worth of attention. What people are looking for there, language skills and technical skills. There's no hard and fast requirement for banking financial services. If, however, you're able to demonstrate some familiarity and usage of, let's say, Microsoft Excel, then that would be a valuable technical skill to include on your CV. The most important aspect would be the activity section. In there, you're trying to do 2 things. You want to demonstrate that you are a well-rounded person with a broad array of interests, and you're doing that to demonstrate your well-roundedness and also demonstrate that you have some form of personality, which is arguably important. So if you've traveled every continent on Earth, or if you backpacked around Southeast Asia, then that's definitely worth including. That tells the reader something about you. And those 2 examples there also tell the reader that you have goals outside of your career, which is fine. You are human and you will most likely be sitting next to a human being. So it's very good for your resume to convey your personality. That is something that a recruiter is looking for. The second goal of the activities section of your resume is to demonstrate that beyond your academic studies and beyond even your work experience, you have made an effort up your understanding of your desired career path. So with specific reference to banking financial services, there are two very, very easy ways that you can do that. Well, let's say three, actually. And for all of you, your CVs should include these three things. First of all, there is nothing stopping you from reading the financial press. And there's nothing stopping you from putting that on your resume. You should be specific. If, for instance, you want to go into investment management, you should say that I subscribe to the Financial Times and I do not miss a Monday edition. And the reason you don't miss Monday editions is because that's when FTFM, so the fund management supplement, is produced and released by the Financial Times. If you want to go into investment banking and you're particularly interested in, I don't know, the let's say the telecoms industry, then you should reference some press or any subscriptions that you have that help educate you about the telecoms industry. Okay, so that's number one, demonstrating that you read around the subject and that you furthered your knowledge in either a broad or specific subject area outside of your studies. The second thing is virtually every college or university will have some form of student investment finance or entrepreneurial society. You needn't be a member of all three, but you should certainly be a member of one. And if you are an executive member, i.e. meaning that you have some say and influence on how that society operates, then that's certainly better than just being a member. But being a member carries value as well, and the value is, again, outside of my studies and my work experience, I'm pursuing an interest in this area. The third very easy way to demonstrate an interest in banking financial services is to run a virtual investment portfolio. And terminology might differ. You could call it a virtual, a shadow, a paper portfolio. What it essentially means is that you have built a portfolio of companies that you have virtually invested in, which means you haven't physically invested money into those companies. But there are a number of tools available to you. Google Finance is a very good one, where you can build a portfolio of companies, and then on a weekly basis you can monitor, or monthly basis or quarterly basis, you can monitor how those companies are performing. That gives you direct access and a direct feel for what the majority of people in the banking and financial services industries are primarily concerned with. What is happening to the value of various companies in various industries across various geographies. And the more informed you are about those things, the more conversation points that you have, better you'll perform in an interview, but equally the better chances you'll have of getting to an interview, because that is the best way that you can demonstrate as to how you've pursued and expanded your knowledge of financial services. On that note, we do run a competition that allows you to do just that, to invest in virtual companies. Oh, well, actually real companies, but you invest in them virtually. The upside is that you'll learn the lessons that I've just described, and equally those that place in the top three, I think it is, will have the opportunity to participate in a CI program that would be fully sponsored by us. So I'll try to remember at the end of this presentation to provide a link to you guys so that you can explore that competition. And even if you don't win, that's a good education and a good addition to your resume. So there are about 5 or 6 slides that follow this first one. I think they're all reasonably self-explanatory, so I'll leave you to go through those slides in your own time. So just to summarize, this slide here describes that your education, professional experience and interests are the 3 key sections of your resume, and there's some description as to why each of those are important and how you should format those various things. We also have a few slides dedicated to the presentation of your CV. It's pretty simple. Your resume is a marketing document. Your, let's call them prospective customers, those people who you want to be persuaded by your resume, they'll likely have a stack of a couple of hundred. You'll want to make the information on your resume not only compelling, but very accessible. And that means that you present your information clearly, concisely. You think about the presentation in terms of leaving white space and overall making the page easy on the eye. This kind of stuff is highly subjective, but it's important that you bear in mind your resume is a marketing document, and the presentation is not as important as the content, but poor presentation is a barrier to people realizing that there's good content there. So it's worth spending as much time on ensuring that it's easy on the eye as it is spending time on the content. Okay. So I'm going to whip through the remaining slides here, and then I'm going to try to arrive at the questions that you've asked. So I'll tab through these. They'll appear and disappear fairly quickly in front of you. There is a marketing your CV section, which essentially says use as many avenues as possible to getting your resume in front of prospective hiring companies. There are, generally speaking, two ways to do it. One is to submit or apply for a job via an online jobs board. Another is to use recruitment agencies. And I suppose the third is to apply directly to employers. There is a fourth channel. I think it's still largely overstated, and that's social media. You can get hold of the right contacts and help supplement any application by building or forming a relationship with an individual. The best channel to do that through is LinkedIn, but certainly you can use less commercially focused social media channels such as Facebook and Instagram to get a general feel as to what a company is doing, and certainly to give you more talking points by the time an interview comes. Okay, so I think we have a couple of questions here in the live chat. So I'll just work through them. Okay, some questions about screen resolution. I'm sorry, I've just seen that, and there's at this point nothing that I can do about them. But what we'll do is send the presentation around, so you'll have the opportunity to spend as much time with each slide as you like, and certainly view it in whatever resolution or format that you like. So I'm just going to answer Scott's question here. He's a junior at NYU and wants to start a career in M&A or a hedge fund. What's the difference? And what skills do I need? Well, I think that's an excellent question, Scott, and I think it is the perfect segue to the topic that I touched on earlier. What is the difference between the buy side and the sell side? So I'll answer your question in the context of describing the overall structure of the banking and financial services industry. I want you to remember one thing, and the one thing is nothing is really that complicated, but certainly within banking and financial services, there are somewhat deliberate attempts to make things more complicated than they are. People in banking and financial services tend to earn a good living, and therefore the more inaccessible, the more complex they can make their job industry sound, generally the better it is for them. So I'm going to describe the structure of the industry in as simple terms as I can without doing any injustice to the industry. Broadly speaking, there are two types of companies within financial services. On one side, you have investment banks. We commonly refer to investment banks as the sell side, and I'll explain why that is later. On the other side, we have investment management firms, and we commonly refer to those kind of firms as the buy side. So if we were to visualize this structure, let's start with a tree with two branches. On the left, we have the buy side, i.e. investment management firms. And on the right, we have the sell side, investment banking firms. I'm going to start by describing what investment management firms do. And there are a couple of different kinds of types of investment management firms. But broadly speaking, and I'll use the terms investment management, fund management, asset management, money management, capital management interchangeably. They all mean the same things. They all describe a buy-side firm. Responsibility is to pull together money from investors with a view to growing the value of that money. So a traditional investment management firm will have investors, and they could be anyone. They could be large institutions with millions or even billions of dollars. They could be individuals with $1 or $2 or a few hundred or a few thousand. They will pool all of their investors' money together and invest the money in assets. Now, there are various different forms of assets that you could invest in. Generally speaking, the ones that we most commonly talk about are equities and bonds. Equities are also known as shares and stocks. So again, I'll use those terms interchangeably. Bonds might be also referred to as fixed income securities. Perhaps if you guys can let me know whether you have a clear understanding of what an equity is and what a bond is, then I can come to that once I finish the buy side, sell side description. Let me know via live chat. Otherwise, I'll assume that you're familiar with what those two core asset classes are and why they exist. So as an investment management firm, my objective is very simple. My clients give me money. My goal is to grow that money for them. The way that I get paid is one of two ways. If I'm a traditional investment manager, then I will charge a management fee. So if you have given me $1,000 to invest, I might charge you a 1% management fee. That means whatever I do with that money, if I make it grow, if I make it shrink, if I lose it all, I'm going to charge you 1% of the $1,000 that you've given me. That's how traditional investment managers work. If I'm a more exotic form of investment manager, i.e. I run a hedge fund, then I'm going to take money from you in two forms. One is the management fee. The second is something called a performance fee. So within hedge fund speak, you'll often hear people refer to a fee structure of 2 and 20. What that normally means is they charge a 2% management fee and a 20% performance fee. So if you've given me $1,000, I'm charging you $20 to manage that for you. And if I make that investment grow by a rate higher than a figure that we previously agree, then that extra return that I generate for you, I take 20% of it. So what I'm referring to there is that you'll give me money. We'll agree on a benchmark, which dictates the rate of return that I should generate for you for investing your money. And if I exceed that agreed benchmark, then I'll collect some of the extra revenue or extra income that I generate for you. Okay, so that is a fairly broad summary of how investment management works. But the idea is they will want to grow the pool of money that you've given them for your benefit and for theirs. So if I grow your investment from $1,000 to $2,000, well, I'm making more money because I'm charging you a percentage of whatever money I'm running for you. If I'm a hedge fund, then I'm even more incentivized to take greater risk for you in order to achieve a greater return for you, because I'll get paid more the more of your money I manage, but equally I'll get paid for extra performance that I generate for you. That's actually a criticism of the hedge fund industry. I'm incentivized to take greater risk with your money because that means that if the reward comes, then I'm rewarded that much more greatly. That's why, generally speaking, some investors are prevented from investing at least directly in hedge funds. So in order to invest directly in a hedge fund, you have to be what's called an institutional or qualified investor. That means as an institutional investor, you're a professional, so you know what you're doing. Or as a qualified investor, you're sufficiently rich that financial services regulators assume that you can afford to lose whatever money you're putting into a hedge fund. That's why hedge funds are more risky. Well, that's not why, but that's pertains to hedge fund investing being generally more risky than traditional long-only investing. I'm throwing a couple of terms at you that I assume you know. What I'll do to wrap up at the end of this presentation is list all of those terms and give you an opportunity to write them down, and then you can go away and research any of those that you're not familiar with. Okay, so I've described the left branch, the investment management industry, and what their role is, and who they provide services to. Now, the sell side, i.e. investment banking, is slightly more complicated, and it's perhaps the most important of the two to understand, to get a general idea of how the financial markets work as a whole. So investment banks provide a variety of services. You'll often hear someone refer to investment banking. Investment banking could mean a number of things depending on the context. But generally speaking, when we talk about investment banking, we're talking about a very narrow area within an investment bank that provides what we refer to as corporate finance, or even equity capital markets or debt capital market services. For the purpose of our conversation, we'll bundle all those services together and call them primary market services. So what that means is that area of an investment bank is responsible for bringing assets to the market for the first time, i.e. they create a primary market for a given asset. What does that mean in layman's terms? It means that if I'm a company, let's say I'm City Internships in 3 years' time. I want to open an office in, I don't know, let's say we want to expand an office in Hong Kong. And we suggest that might cost about $1 million to acquire office space and build a team there. As a company, I have a couple of options available to me to fund that activity. We may have reserves, cash reserves that we could dip into in order to facilitate that growth. That's one option. Most companies don't retain that much cash in their business, and certainly not large companies, given that they want to put the money to work. Money in the bank is money that's not generating you a return that you could otherwise generate. So either that money isn't there in the first place, or as a company, I might not have an appetite to use that money, in which case I could, like any individual, go to a retail or commercial bank and ask for a loan. That tends to be reasonably expensive. So to get, let's say, an unsecured personal loan in the US or the UK, you're looking at paying about 7% interest. A secured loan, i.e. if you don't repay the loan, there'll be some asset that the bank will be able to take. You'll generally enjoy slightly lower rates. But in any case, going to a bank and getting a loan is quite an expensive way of borrowing money. So I could go to an investment bank and they could help me raise money to grow in one of two ways. We could either sell shares in City Internships, or we could issue debt. So let's focus on the first, which is selling shares. Let's say we value City Internships at $10 million, and it's going to cost $1 million to build this office in Hong Kong. We therefore might only want to sell 10% of the company in shares. So how that would work is that an investment bank would help City Internships not only establish a value of the company and set aside a portion of the company to make available publicly. It will then market the sale of those shares in City Internships to any investor that might see City Internships as an attractive investment proposition. So generally the mechanism, and there's a couple of ways to do it, would be City Internships would hand over a certificate to an individual that says you have, let's say, 1 share in City Internships, and in turn that individual would channel funds to City Internships. Now, that share held by the individual entitles them to a share in the future profits of City Internships. It doesn't entitle them to anything other than that. So if in 2 years' time they decide that they want their money back, the only way they can do that is by selling that share to another person. And that's the secondary market activity, which we'll come on to in a second. So now focusing on the other option, issuing debt, there may be a reason as a business that I might not want to give away ownership in City Internships. It could be because I think that the company is going to grow so quickly that I want to be the sole beneficiary of that rather than dilute it by allowing people to share in City Internships profits in the summer, in the future. It could be because I don't want to relinquish any control or decision making as to what the company does in the future. Or it could be any number of other reasons. So what I might do instead is issue debt. Now, what that is me handing over to an individual group of individuals or company a certificate that says, if you give me, let's say, $100, this certificate entitles you to interest over the next 5 years, let's say of 5%. So I'm going to give you $5 every year for the next 5 years. Then at the end of those 5 years, I'll give you your original $100 back. So we're sort of touching on the difference between equities and bonds. And what you'll see is, as an equity holder, you have a share of profits, but no claim on getting your money back. If you are a bond holder or a debt holder, you give a certain amount of money, you get a fixed return or fixed income coming back to you, and then you get your original investment back to you at the end. What I'd encourage you to do is read up on something called pecking order theory, which describes the different kinds of capital raising avenues available to companies and the various reasons as to why a company might choose one or the other. To summarize, I'm a company. I want to raise money. Instead of going to a bank or dipping into our own reserves, I've engaged with an investment bank. They've helped me raise money either by issuing shares or issuing debt. And what that means is the investment bank and I have created assets that can be traded by individuals from here on. So the trading of those assets that have been issued is generally referred to as secondary market activity. So the other areas of an investment bank, the sales and trading division, for instance, the research division, for instance, they are concerned with helping people trade in and out of existing assets. That's what sales and trading teams do. And the research division is responsible for helping people assess the future value of an existing asset. So let's say that City Internships have issued shares, and that statistics like we help alumni get hired 3 times more quickly and 30% more continue to be proven and continue to improve, then that might send a message to the market that actually City Internships is going to grow. A lot more people are going to be interested in City Internships in a year's time than they are today. And that might affect the perceived value of City Internships shares, or even the perceived quality of the bonds that we issue, i.e. those bonds are much safer, they're more likely to be repaid. In any case, the existence of that perception in the secondary market would affect the value of those securities, i.e. it would increase demand for those securities, which would in turn increase the price. So the job of anyone involved in secondary markets is to help predict the future value of assets that have already been issued. I'm not quite done yet, but I'm about to bring together how the buy side and sell side work together. So this secondary markets area of an investment bank, sales, trading, and research, they primarily serve the buy side. So I'm an investment manager. A collection of investors have given me $1 billion. I will perform my own proprietary research into how best I think to invest that $1 billion. But equally, I might lean on the research department at investment bank, who would focus on a given market with much more granularity than I would be able to on my own, and therefore they could give me more insight than I could gain on my own. So I might go to an investment bank and they'll say, do you know what? We think City Internships is a strong buy. We'd recommend that you invest a certain amount of your portfolio in City Internships, in which case I'd then interact with a trader at the investment bank and say, I'm going to put a buy order with you on City Internships stock at $1 a share or something like that. And then it is the role of that trader to acquire those shares for me. I've dramatically oversimplified the role of a trader. That's not really how the mechanism would work. A trader would really constantly quote a price at which they're willing to buy, a price at which they're willing to sell a given asset. There would be a margin between those two prices, and that would be how the trader makes money. But generally speaking, that's how the sell side is structured and how the sell side interacts and provides services to the buy side. So in a long and roundabout way, coming back to your question, Scott, the difference between what a hedge fund does and what an investment bank does is dramatically different. A hedge fund is responsible for actually investing money and making investment decisions. An investment bank, broadly speaking, is either responsible for assisting an investor in those activities or helping a company in the first place create the assets that an investment manager would seek to invest in. I hope that's a reasonable and balanced description of the industry that's been well understood by most. The live chat feed looks like it's died a death. So I'm going to take that as a good thing, and that I've answered most of everyone's questions. If you have any questions, then speak now, or forever hold your peace. There's one last question actually. So Preston, what literature did I read to educate myself? Well, there's a couple of fairly obvious sources that you could use. The Financial Times is a very good one, as is the Wall Street Journal. I actually really like a website called Investopedia. It's essentially a glossary of financial terms. And on that note, I'll give all of you this exercise. I'm about to reel off a list of terms that I'd encourage you to punch into Investopedia and learn about. What you'll find is that you'll read one term, and in reading the description of it, you might come across another term that you're not familiar with. That's the way that I educated myself before I then had the opportunity to speak with people directly and learn about industry more directly. And those conversations are certainly much better informed and will play out much more productively if you have a degree of understanding before you enter into them. So here's a couple of terms that you could punch into Investopedia. Buy side being one, sell side is another. Within the buy side, you have two kinds of investment strategy that are important to understand the distinction between. One is called a relative return investment strategy. The other is called an absolute return investment strategy. So if you're looking to start a career on the buy side, then I'd suggest that understanding those two terms is a good place to start. How do people make a decision as to whether they should invest in company A or B? Well, there are any number of ways that you can do that. You could roll a dice, and history suggests that might not be the worst thing to do. Or you could be slightly more scientific about it. So modern portfolio theory has spawned a couple of forms of research that are broadly used in the industry. So one is called fundamental research. And that is what it says. You look at the fundamental structure and financials of a company and make a decision based on that. So fundamental research is really the most logical and common sense of the various research methods. You familiarize yourself with the company's financial statements. You also familiarize yourself with the company's leadership and their strategy. It's almost looking at the company from every angle and then making an investment decision off the back of that. Another investment strategy or research strategy is called quantitative analysis. And all you do, you might not even know what the company name is, what industry they're involved in, what products they have, who's the CEO. All you care about is building essentially a model which tells you if certain, let's call them macroeconomic statistics, behave one way, then the value of this company is going to behave a certain way. So if, for instance, you build a model and you run regression analysis that says every time the price of oil goes up by 1%, this set of companies increase in value by 2%, then what you'll do is make a prediction as to what's going to happen to the price of oil. You'll plug that figure into the model and it will essentially suggest that these are the kind of companies that you can invest in. It's very different from fundamental research in that, as I said, you don't need to know anything about the company. You just need to know how its share prices have performed over a certain period of time and how those prices have interacted with whatever economic data you might choose to look at. Another form is called technical analysis. It's probably the most easily scrutinized form of research amongst all of them. All you do is look at a price chart of a given security, and then you can use some statistical methods and sometimes just visual methods in ascertaining where that price meets resistance. So you'll notice that the price commonly oscillates around, value X, and once it drops by 10%, it tends to rebound. If it increases by 15%, it tends to rebound. So what you're essentially doing is looking for patterns in the share price and trying to ascertain the direction of the share price now suggests that it will be moving in this direction at some point in the near future. It's perfectly reasonable and logical to combine all of those research methods in making your investment decisions, and most professional investors do exactly that. Generally speaking, the world of investing has become much more scientific, much less of an art, much more of a science, as as time has passed. So you need to be numerate, comfortable with numbers, and at the very least comfortable with debating your ideas and arguing your views and opinions. I would suggest that those are the two requisite skills or attributes to have if you're looking to go into the buy side in your career. On the sell side, there's two very different career paths. If you go into investment banking, which might lead to a career in M&A, your career will be much more project-based. You'll have a company or set of companies that you'll be working with at any given time. There will always be an impending deadline. That's why there are never enough hours in the day. If you're working in an investment bank, that's why you'll work 100 hours a week in your first few years, because there are always projects to be done. There are always deadlines, and there are always new projects to be brought on, of course, if you're successful. If you're on the investment management side, or indeed in sales, trading, or research, then your day is centered around the market that you invest in. So most markets are open from 8:30 to 4:30 local time. So that governs your day. So you might get in before the market opens to perform some research. You might leave slightly after the market closes. But given that it's an ongoing job and there isn't necessarily a recurring deadline, you can expect your working hours on the buy side to be slightly lower than your working hours specifically within an investment banking division on the sell side. Okay, well, I think that draws the presentation to a close. So thank you very much for listening. Thank you for tolerating my highly monotone voice. What we'll do is send all of you an email so that you have the presentation that you can go through in your own time. Within that email, I'll make my contact details available to you, so that if you have any follow-up questions, I'd be more than happy to fill those on a one-on-one basis. The general parting comment that I'd like to leave you with is that the graduate market is a very competitive place, and what we're seeing suggests that it will only get more competitive. Demand for graduates is struggling as employers increasingly fail to see the relevance of some degrees to their business. Equally, the supply of graduates is forever increasing, despite tuition fees going up. More and more people want to go to college. So it's a very, very competitive market, and will only be more so as the years roll by. What we do know is that there are proven ways that you can make the most of your investment in your education. Having a good CV is the most important thing that you can do. On your CV, outside of your academics, the two most important things are work experience and your extracurricular activities and interests. So get relevant work experience that help demonstrate to a prospective employer that you're not a risk, that you know why you want to work in industry, you know that you're capable, and you can demonstrate that because you've done it already in your work experience with a similar company, or any company for that matter. With regard to your extracurricular activities, that's your way of demonstrating, I really am sincerely interested in a career in financial services. This is what I've learned about it. This is what I've taught myself about the industry over the last few years. This is why I know I want to do it. And therefore, I'm not going to get hired and then become disillusioned in 2 years' time and therefore prove to be a poor investment to you. Your CV is your way of providing evidence to an employer that you're a sensible and sound investment. And there are a number of proven ways that you can do that we've hopefully addressed during this presentation. So thank you for your attention. Keep an eye out for the email that's coming soon. And as I said, I'm happy to field any questions that come back as a result. Thank you.